I hope you did.
Yes, Professor.
Yes, I did.
All right, good. Let's do that. Okay. All right, so let me share the screen. All right, good. So we are moving on to the new topic today, topic 5, real options. Okay, real options. So of course, we need to, and I believe, this file is already, uh, we've been constantly working using, you know, it's the same file, but okay, real options here, right? So you need to open that file. And what's this update? So okay, go ahead and do the update. Um, and of course we need there. And so first, let's think about what options are. But there are so many things that before we go into the discussion of option. First of all, let's define what risk is, because this is an extension of capital budgeting, right? Real option. This topic is an extension of capital budgeting, and in capital budgeting, we have taken for granted all the cash. We have taken these cash flows to be for granted. We have taken for granted that the cash flows are point estimates, or handwriting is point estimate. What does that mean? Just one single definitive value. But is that really the case? I mean, can we make such a definitive forecast? Cash flows are basically forecast, right? Because we are talking about the future cash flow. So the future cash flows are forecast. But can the forecast be a definitive value? No. Forecast, everything has a range. Everything has a range, right? When Federal Reserve says they are going to raise interest rate by, 50 basis point, right? So, then Fed funds rate will be in the next, after the next FOMC meeting, then it's going to be 0.75%. No, it will be more like the range will be somewhere between 0.7 to 0.8 or something like that, right? So most likely actual market Fed funds rate, actual Fed funds market rate will be somewhere in between. So it can be. So sometimes it can be 0.75% exactly. Sometimes it could be 0.7625. Sometimes it could be 0. Right? Actual market rate will fluctuate within that range, right? So it's not a point estimate in reality. So in reality, cash flow estimates have a range, like and this is a very well-known bell curve for normal distribution curve, right? Normal distribution curve. And normal distribution curve has, normal distribution is a most commonly found distribution in random variables. Random variables are literally, something that occurs at random. For example, stock prices, day-to-day stock price movements are random, day-to-day, in the short run. In the long run, there is a trend, definitely. We can identify some trend, but day-to-day stock prices are not correlated with each other. Yesterday's stock price is not necessarily correlated with today's stock price. Tomorrow's stock price is not necessarily correlated with today's stock price. It's called a random walk, right? In the short run, it has a random walk. No specifically identifiable pattern. In the long run, we can identify a pattern, right? So it's like you might think, for the last couple of days, for the last few days, stock has declined. So aren't they correlated? Actually, they are more. It's not that yesterday's price is correlated with today's price, or the day before yesterday price is correlated with yesterday's price. It's just it's an optical illusion. It may look like that, but actually, all these stock prices were day-to-day stock prices were more correlated, more influenced by the external factors, not the dynamics in the data. External factors are, of course, the Fed announcing. It's all been anticipated. It's nothing new. Fed is going to raise short-term interest rate by 50 basis points in the May meeting, right? May FOMC meeting, right? It's been already fully anticipated, but I don't know why the market likes even if it is a bad news, the market wants the confirmation. And empirically, I've been watching the market for more than 20 years, and empirically, even if it is a bad news, once it is confirmed, the market rebounds. Before the confirmation, even if it is the bad news, before the confirmation, even if it is the good news, before the confirmation, the market can go down. After the confirmation, even if it is a bad news. But so external factors like inflation, supply chain, disruption, and the interest rate, possible interest rate hike, and all these things. Those things depress the market. I've been telling you, every day since February, the market has shown most of the times, a decline rather than, even if there is a small, recovery, soon wiped out by the further decline. And I personally, my portfolio is about 11%. My portfolio lost about 11% from its highest point, and the highest point was around January 9th, and since then it lost. But day-to-day stock prices are not correlated with each other. In other, each other means its own price yesterday, right, or the day before yesterday, right? So they are. It's like every day. It's almost like random selection. Remember what random selection is? If you have a sack of balls, right? Let's say there are 60 white balls and 10 red balls, or 50 white balls and 10 red balls. So 60 balls are in a sack. You put your hand and randomly pick up one. What's the probability of that ball to be white? there are 60 bulls there, right? I mean, if there are 50 bulls, the probability will be 1 over 50. 1 over 50. But there are 60, so it has to be 1 bull out of 60, so 1 over 60, and then times 1 over 50. It's a joint probability. It's called a joint probability, right? Both conditions, both probabilities must be, jointly happen, right? But then think about it. It's like, every day the stock return, right? It's like drawing the bull from blindly drawing a bull from a sack of, a lot of bulls, right? And every day it repeats. And, after drawing a bull, then you put it back in there. And let's say there are numbers on the bull, right? Which one is going to come up? It's really a random variable, isn't that right? That's what random variable. So random variables, we can tell random variables have normal distribution properties, right? Random variables have normal distribution properties. And normal distribution is well known by the property of having the mean expected value is called, also mean. Expected value is the mean, right? And then it's got a standard deviation. Now the drawing is a little, one standard deviation above the mean, one standard deviation below the mean. And then 2 standard deviations above the mean, 2 standard deviations below the mean. And so I'm not going to go into the properties of normal distribution, but we know that the probability of getting something, let's say this is stock and Apple's return. Let's say Apple's monthly average return is 3%. Okay. So over the last 5 years, we've been following. Over the last 5 years, we got the data, Apple's monthly price data, and from the monthly price data, we can calculate return. So there will be 60 data points because it's 5 years, right? 60 monthly data. And then if the mean of that monthly returns is 3%, and one standard deviation is 8%, so 8% above that will be 8%. This will be 11%. Another one standard deviation above that will be 19%. Okay. And one standard deviation below mean will be minus 5%. 2 standard deviations below mean will be negative 13%. But think about it. What is the probability of, the normal distribution tells you that the probability of earning anywhere between negative 5% and 11%, right? That's one standard deviation around the mean, right? One standard deviation around the mean. That probability is 68%. It's a well-known, statistical fact. So that means if two ways, right? Both ways, above the mean and below the mean. So one standard deviation around the mean, right? Then the probability of getting a return between 3 and 11% is 34%. And the other way, earning anywhere between negative 5% and 3%, that probability is also 34%. Now, this may be, you might think, you might get confused because everything is in percentage. But remember, what's on the horizontal axis is Apple's return. Okay, the stock's return. This percentage is the return, rate of return. Whereas this percentage that you see here is the probability of that return happening, right? So if the one standard deviation around the mean, the probability of getting any return between one standard deviation around the mean is 68%, and then the probability of getting something within two standard deviations is 96%. Okay? So everyone is okay with that? Now, so if you are, what is the probability of getting a return? That's between negative 13% and 19%. The probability is very wide, 96%. Look, because it's anywhere between negative 13% and 19%, right? But we can narrow it down further because we know the probability of earning any return between 3 and 11% is 34. The probability of earning anything between negative 5% and 3% is another 34%. Then, so one standard probability of earning anything within one standard deviation around the mean is 68%. Then, if that is 68% out of 96%, 68% is already explained. Then the difference is what? Difference between 96 and 68% is 28%, isn't it? 28. So then that 28, out of the 28, 14% is here, and the other 14% is here. Okay? You see what I'm talking about? So the probability of earning then what's the probability of earning anywhere between 11 and 19% return? That probability is 14%. You have 14% probability of earning anything between 11 and 19%, right? Also, what's the probability of earning between, negative 5 and negative 13%? Same probability. It's got the probability, also 14% probability, right? So, and then if two standard deviation around the mean, the probability of two standard deviation, anything between two standard deviations around the mean is 96%. The remainder is only 4%, isn't that right? And those of the 4%, 2% belongs here, 2% belongs here. So think about it. If you earn, what is the probability? If you earn something like 24%, 22% return, the probability of earning such an extremely high return is only 2%. Also, the probability of, if you get negative return, that means you lost, right? Mm-hmm. Earning, let's say, extremely low return, like negative 16%, probability is only 2%, right? So 2% probability on 2% probabilities are extreme tail end, right? Extreme tail end probabilities. This is right tail, left tail, right? Extremely low probability. So this is basically what normal distribution is telling you, and then that is also that can be applied to our cash flow estimation. So think about it. In capital budgeting, we have initial investment. It was as if it was definitive, 50 million, right? As if no, 50 million is the most likely number, right? It would be more or less 50 million, right? It would be more or less 50 million. Make sense? So it's got a range. And 50 million is the mean of all the possible cash flow at time 0. Cash flow at time 1. This is only the mean, right? Mean. If they say 20 million, 30 million, all those things are, we have to understand, 25 million, those numbers are basically mean with, standard deviation around it, right? With the probability of 34% of one standard deviation above the mean, with also another with the probability of 34% of another one standard deviation below the mean. So then basically that brings us back to the concept of risk. So people generally think risk is, a probability that something bad will happen. In financial market, probability that you will lose money, right? In finance, risk generally is interpreted as the probability that you will lose money, right? Or negative return. However, even it's not just the negative return, it's both positive and negative returns. Above and below positive and both positive and negative returns. Positive and negative, above and below the mean. Okay? So again, think about it. Apple, right? Let's go back to Apple and think about it. If Apple's mean return is 3%, monthly return, mean of the monthly returns is 3%. And if you get anything below 3%, you think that's the risk. No, that's definitely risk, but it's called downside risk. If you earning anything below that mean is called downside risk. Downside risk. But earning anything above the mean of 3% is also a risk. It's called upside risk. Upside risk. So generally, upside risk is not considered as risk because people would welcome upside risk. Isn't it right? If you're earning anything above the mean return, is a pleasant surprise. It may be a surprise, but it's a pleasant surprise. Nobody will say, "Oh, damn! I earned 10% more than the mean return." Oh, damn! Nobody will say that, right? But still, no, it's understandable if they say, "Well, damn! I earned 10% less than the average return." Then that's understandable. But you won't think anybody will say, "Damn, I earned 10% more than average." But the reason even the upside risk is still called risk is because it means the volatility, right? It means the volatility. I mean, the wider the variance, the greater the volatility. And more volatility is clearly, higher risk, right? Because the volatility doesn't only work in the negative direction, right? The volatility works both ways, negative and positive, right? If there's a negative swing, there's a positive swing, right? It's also like, think of it this way: if you're driving a car, and this is a used car, so it's not very reliable. If you keep your hands steady on the steering wheel, if it is a good car, it should stay on course. It should stay straight on course, right? Just by keeping your hands on the steering wheel. If it is a bad used car, a lemon, right? It's very unreliable. Even if you keep your hands steady, the wheel will be wobbly, right? It's gonna, wiggle to the right, wiggle to the left, and once it wiggles to the right, just because it is right side, it doesn't mean it is good, right? If the car is swerving to the right or swerving to the left, either way, it's bad, isn't it right? Mm. The same idea. Volatility is basically unpredictability of deviating from the mean, right? So that is, why the estimates have range of variation, right? And that range of variation is a risk, and that's something we have to consider. So far, in capital budgeting, we treated cash flows just as a definitive number, right? That cannot change, but actually we have to understand that it's only a mean value, and there can be variations around it, a range around it. So when we have two projects, right? Project A and Project B, and the net present value of A, net present value of B, and when you look at the net present value of A and B, of course you will say, oh, Project B is definitely better. You will say Project B is better. It's got, higher net present value. But can we really say that when we consider its risk, right? Project A has mean estimate of 12 million for its NPV, but its variance is smaller, right? Its variance is much smaller. And Project B, although with the mean of 13 million, mean cash flow of net present value of 13 million, but its variance is wider. So how do we compare this? Well, one very solid and straightforward metric, very solid metric, is mean variance ratio or mean standard deviation ratio. In other words, mean of A, standard deviation of A, mean of B, standard deviation of B. Now think about it. What is this? This is like gas mileage. Isn't that right? This is output to input ratio, output to input. What's the gas mileage? Everyone knows what gas mileage is, right? How many miles per gallon? And how do they measure gas mileage? How do they calculate it? It's very simple. If your car has 20-gallon tank, you fill it up. You know how many gallons are there? 20 gallons. Drive the car until you run empty, until the tank goes, gas tank goes to empty. So, and then if you got 800 miles on 20-gallon tank, right? The gas mileage is 800 divided by 20. So that's like 40 miles per gallon. 40 miles per gallon, right? Of course, if your gas mileage is 40, per gallon, that's a great gas mileage, isn't that right? Even 30 miles per gallon is a great gas mileage. Right? Obviously, this measures the efficiency of your car. Isn't that right? Efficiency or productivity of your car. So you can compare. If you know the gas mileage, you can stack up different cars by gas mileage. Whichever has the highest gas mileage comes on top. Lowest gas mileage, right? But now think about it. Nobody wants low gas mileage. Isn't that right? Is there anyone who wants? If you want low gas mileage, you shouldn't drive a car. You should drive a tank. If you drive a tank, you'll get desired low gas mileage, right? Question? Yeah. Just wanted to flash your nails. So think about it. This is just like gas mileage, and gas mileage is exactly output to input ratio. Isn't that right? Gas mileage is exactly output to input ratio, because how many miles? That 800 miles, that's the output. 20 gallons, that's the input, right? Just like that, the variance or the standard deviation, of course, this is standard deviation. Standard deviation is just square root of variance. Actually, standard deviation is a bigger number than variance. Why? It might be, sometimes, this may be counterintuitive, because variance is standard deviation squared. Isn't that right? And the standard deviation is square root of variance. And think about it, because between the square term and the square root, you normally think square root is smaller, square term is bigger. But actually, we are talking about a number that is between 0 and 1, right? Something like 20%, 40%, 30%, right? These are the numbers between 0 and 1. And when we are dealing with numbers between 0 and 1, if you square it, it gets smaller. Isn't that right? 20%, you square 20%. What is it? Becomes 0.04, right? 0.2 times 0.2 squared. So it becomes 0.04, right? So variance is a smaller number than standard deviation, right? And then, so standard deviation is the risk because it's the measure of variation. It's the measure of variation. So risk is what we take to get certain return. Risk is what we take to get certain return. So that's the input, right? Standard deviation, risk is the input. The mean cash flow, that's the output. So that's the output to input ratio. So it works exactly like the gas mileage. And then whichever number, the fraction, this is a ratio is a fraction. So whichever is greater, that's a better project, isn't it right? So this defies our understanding so far, because our understanding was, in capital budgeting, we only need to find net present value, and whichever has a greater net present value, that's the one. Isn't it right? If you have two mutually exclusive projects or two competing projects, we find net present value or internal rate of return. In both cases, the greater net present value or the greater internal rate of return, that's the project that you choose, right? But that's because when we don't consider that there is risk or the variability or the variance in the cash flow to be generated, we can do it simply like that, right? But when we consider the variance in the cash flows, right, the risk in the cash flows, you cannot simply go over 10 million. You have to consider this ratio, output to input ratio, right? And if you consider that, it can be like this, right? So that's the reason behind real options. That's the whole idea behind real options, because we have options that can give you these different range of variability, right? So here's the, I already explained, importance of, risk aversion, right? So several ways, so how do we, several approaches to incorporate risk into capital budgeting. One thing is called scenario analysis or sensitivity analysis. Scenario analysis or sensitivity analysis, right? Some of you are taking Finance 300 at the same time, and this is something, scenario analysis, what you're saying is there can be different scenarios, right? Mm-hmm. In other words, let's say we have a portfolio of $10 million portfolio. And what's going to be the return on this portfolio next year? We have several possible scenarios, The economy may be good or boom. The economy may have a boom or just, a good economy or regular, two possible, states of the economy, right? Boom, just regular good, and mild recession, and severe recession, right? There are four possible scenarios, right? We don't know what's it going to be next year, right? But we need to incorporate these four different scenarios. So we'll have, scenario or sensitivity analysis, okay? And each scenario has possible states have probabilities associated with it. What is the probability of severe recession? What's the probability of mild recession? What's the probability of regular good economy? What's the probability of economic boom? And so it's weighted average, right? Basically weighted average. The result is the weighted average. So here, in our example, just worst, most likely, and the best case, right? In our capital project, right? Worst, most likely, and best case. And what's the probabilities associated? So we recalculate net present value under each scenario. So here, in worst case, cash flow at project A has an initial outflow of 1,400. So that's C0, right? And then in the worst case scenario, cash flow in year 1, year 2, year 3 is going to be like this. Most likely case is going to be like this. Best case is going to be like this. But of course, we will need to have probabilities associated with them. So here, let's take a look at the next example. The worst possible net present value will result if three lowest cash flows all occur. Assume the cost of capital is 9%. Okay, this is the worst case. In other words, when this is happening, when this happens, we'll have negative net present value. We do the similar calculation for best case scenario, and the NPV will be positive 3. And the most likely scenario, right? Then we have net present value of this. So then we need to combine these. To combine these 3 different cases, we need probabilities. How do we know the probabilities? This has been developed already, since the early 20th century. Monte Carlo studies, what they call Monte Carlo studies. Monte Carlo, it's basically, running simulation with computer, running, hundreds and thousands of simulations with a computer, and then the computer will generate probability distribution, something like this. So the NPV ranges, right? NPV ranges, negative 100, 0, $100, $200, $300, $400. I mean, using the previous cash flow scenario, right? And then look at the total number of these observations. I mean, 1 through 600, right? If you, that's like, 7, 3 pairs. They made at least 2,100 observations. They ran at least 2,100 simulations. How do I know? You add them up. But how do you quickly add them up? This plus this is 700. This plus this is 700. This plus this is 700. We have 3 pairs of 700. So 700 times 3, 2,000. So we can tell they ran at least 2,100 simulations. And from those simulations, net NPV of 100, 600 times that came out. And 400 times, 0. Right? 500 times NPV of, 200, right? So, and almost, this may be 100 or less, not sure. It's not exact. I'm just, approximating, right? This may be more than 500. But anyway, maybe, 70 times, negative 100, right? 300 times, something like, $300, that's like 250 times came out. So this way we can associate these results with probabilities, right? So now we have probabilities. Now decision tree. This is we had, in the previous example, we had at least three possible scenarios, best case, most likely, worst case. But here, the decision tree is basically a tree diagram like this. And this is a very simplified tree diagram. In other words, we have only good and bad. Okay? Not like, best case, most likely, worst case, but just good and bad. So this is probability of, so cash flow 0, and after cash flow 0, cash flow at 1, and then after the first year, we have two possibilities. One possibility, they assigned 60% here, 40% here. So there's a 60% probability that the cash flow will be high in year 2 and year 3. 40% probability cash flow will be low in year 2 and year 3. So how do we find net present value? We find net present value in each case, and then we weight it by the probability, right? And okay, which is, and you are all familiar with weighted average, because we've done, weighted average cost of capital. So here, let's take a look at this example. Wingfoot Shoe Company is considering a 3-year project to market a running shoe based on new technology. Success depends on how well consumers accept the new idea and their demand. Demand can vary from great to terrible, right? But for planning purposes, management has collapsed the variation into just two possibilities, good and poor, right? So actually, the outcomes can be range between. We can be more specific, like great, good, okay, bad, terrible. There can be 5 possible scenarios, but we just, for management purpose, they collapsed it just into 2 possibilities, good and poor. Market study indicates, so something like Monte Carlo simulation will indicate 60% probability that the demand will be good, 40% probability that it will be poor. $5 million, that's C0, that's initial investment, right? C0, 5 million. And the cost of capital, 10%. And the cash flow estimates, 3 million per year for next 3 years at full capacity if demand is good. 1.5 million per year if demand is poor. So we know that means, C1, C2, C3 on the good case, 3 million, 3 million, 3 million, right? on the bad, right? Poor demand, or it's 1.5, 1.5, 1.5. Right? So let's find the net present value in this. Okay, so I'm gonna let's use this. Okay, open this file. Open this file. And this is not that difficult. We only, in the past, we've done this, net present value, capital budgeting, right? The first thing you need to do is, but something that is different from our capital budgeting model is that we have probabilities, right? So here, we know what to do. Present value in the time zero, it's the same thing, but I'll still do that. I will still discount it. 1 plus 10% and lock it. And then raise that to 0. And then I drag it down. The same thing here. This divided by 1 plus 10% raised to 0. And then drag it down. Oops, I didn't lock it. Okay, so lock. And drag it down. Okay, and these things are not negative, so I don't need it to be in red font. Change that. And then net present value, we use auto sum. Use auto sum. We get the net present value. Then we multiply that by probability. We multiply that by probability. Multiply this by probability. Okay, and then so what is this? Weighted out. So since we weighted it by its probability, right? If we sum these two, then that's the weighted average net present value, right? So considering both bad and good case, still we'll have positive net present value from this project, right? Everyone is okay with that? Let's compare that with, yeah, this is what the book did. Expected net present value, 0.968 million. Yes, that's what we got here. Okay. All right, so any question? All right, this is relatively easy so far, right? Okay, so if you have no further questions, then the class is dismissed. I'll see you guys on this Wednesday.
All right, good night.
All right, good night.
Stay home safe, everyone.
All righty, so I'll have to, oops. All right, guys, any questions on?
Thank you, Professor.
All right, you're welcome. Take care, everyone. So
Thank you.
take care.